All right, I think we are live. Hello and welcome everybody to today's workshop. I have a very special guest for you today, Elizabeth Humphreys, and she's going to be sharing with us about opportunity zones. So you may or may not be familiar with opportunity zones. This is I think it's a concept that's been around for a while, but Trump and some of his partners there had really expanded this program. And I went to watch Elizabeth present over here in Southern California, and I was really blown away by what this opportunity zones have as really an opportunity if you are looking to get rid of some of those pesky capital gains taxes and you don't need the money you're going to invest for certain periods of time. So it's a really beneficial program. And in all honesty, the areas where these opportunity zones are placed are generally in areas that haven't been invested in sometimes 15 or 20 years. So it's a really excellent program. I think there's generally some confusion around how they work, what the benefits are, and how to really take advantage of them as an investor. So I have Elizabeth here with us today, who's going to be explaining all this, breaking it down, and then helping you understand if it is right for you and possibly where to invest in opportunities if it's something you're looking to get involved in. So let me bring Elizabeth on here in just a moment. All right, Elizabeth, are you with us?
I am. Hi, Jason. Thank you for
Hey,
having me.
excellent. Welcome, welcome. So we're here on my Facebook page, my Facebook group. So hopefully there's a lot of people tuning in today. And there's a lot of folks here that I know love to save on taxes or not pay any taxes at all. So I think with what you're going to talk about today, that might be something that might be a good fit for those type of folks. Would you say that's the case?
Yeah, absolutely. And that's what's really wonderful about opportunity zones is they create a mechanism to not only defer capital gains, but actually have a full elimination of gains after that sale in 10 years. And, I'll talk a lot more about how that mechanism works and, the specific tax benefits, but it's really incredible. It's an incredible tool and a great incentive to invest in some of these geographic areas that need it.
Hmm. I love the idea of being able to completely eliminate taxes. So those opportunities seem to be getting a little more and more slim as things go along. And we're going through, in our group here, we try to really avoid talking about politics at the end of the day. We really try to stay away from that. I want this to be a place where we can really focus on finances and taxes because at the end of the day, 4 years from now, there's going to be another president, or 8 years from now, whatever it may be. And we're still going to be here. We're still going to be trying to not pay taxes and become better investors and do the best things we can with all the resources we're given to manage. So, do you want to tell us a little bit about yourself and how you got into opportunity zones and opportunity zone funds, and just share with us, why you're so passionate about this particular subject?
Well, great. Yeah. So I actually have a law degree from the UK. And then, I really specialized in working at, capital gains taxes there, and particularly corporate law. But then when I returned to the United States and I was working in California, I went into real estate, specifically doing commercial real estate brokerage and really working a lot with developers for multifamily. And I was actually, most of my deals were in Hollywood, and that's where there was a lot of development going on. Hollywood is also, interestingly, an opportunity zone.
Mm-hmm.
That's why when all this legislation came out, a lot of the developers I was working with to either acquire land or sell their properties were in opportunity zones. And they wanted to know more about this legislation. And because of my legal background, granted it's in the UK, but it still is applicable, at least for the understanding of this legislation, I ended up consulting for them on a lot of these, just legislative issues. And then that really turned into creating opportunity funds, qualified opportunity funds for them, and setting that up. And now where I'm at is continuing to do that for developers, but also I've become the GP and manager of some of these funds, and that's where looking to raise equity, for these projects that are in opportunity zones.
Excellent. So is this something that you think is saturated at this point, or is this really just a beginning of what's really possible with these opportunity zones?
I really think we're just getting started. This year has been a crazy year for everybody. But what has really been interesting in the opportunity fund space is the final regulations from the IRS only came out in early 2020.
Mm.
So we really see a lot of activity before that because investors couldn't be confident that what was going to happen, or if there was going to be changes to the regulations that would mean that their investment would no longer get the tax treatment that they wanted. And so now we're seeing a lot, people are really confident. They understand how this legislation works because it's now has been finalized. And that's, we're really seeing, I mean, I'm getting more and more requests from developers to set up funds. It's I think it's definitely only getting started.
Excellent. So I'm really looking forward to learning about what you have to share today. Just as I want to bring knowledge to everybody here that's tuning in today, I also want to learn from myself. So, I've learned from you before, I've done some research, but it still feels like there's just so much to know and so much to learn in this sense. So I think having an expert come teach us is going to be really great for everybody. So what I would like to do is I'm going to get you set up here and I'm going to have you take over and share your screen. And then from there, just get into what you want to talk about. And for anybody that's watching, if you have any questions about opportunity zones, please put them in the comments below. And once we are done with Elizabeth's presentation, we'll address as many questions as we possibly can. And we'll do our best to get the answers you're looking for here. So Elizabeth, I'm going to set you up here.
Great.
And hopefully you should be in good shape. Let's see. Are you able to share your screen there?
Let me see.
There we go.
Does that work?
Should be good there.
Fantastic. So there's my disclaimer. As I said, we are legal experts, very important that we have this. And that's where, I did actually already go over a little bit of my background. I've put that in there as well, but, I won't go over any more of that. But so let's just get started talking about why qualified opportunity funds are so unique and such a good tool for investors. The really, really key thing that differentiates it from any other option to roll over gains is that gains can be rolled over from any source. So not just real estate. So that includes stock gains and gains from the sale of a business, partnership interests, anything that is a capital gains event. Then, as I mentioned, with that 10-year hold period, when you hold your interest in a qualified opportunity fund for 10 years, upon sale of that appreciation, that interest is not taxed. So I put a little example in there. That means an investor can roll over 100,000. If that grows into 250,000 over 10 years, that 150,000 of gain is not taxed. There's really no other mechanism that allows for that. And especially as we're looking into these areas that are appreciating and growing in those areas, especially looking at Hollywood in particular, that we would expect to see over a 10-year hold period a pretty substantial gain. And to have that ability to sell and have that not taxed is really the major incentive here. That initial capital gain is deferred until 2026, and then 90% of that is taxed at that time. That's something that people often get confused. They think that if they hold for 10 years, they never have to pay their original tax, and that's not the case. You get that original tax is deferred until 2026. You do get a little bit of a step up, but you do have to pay today's tax in 2026. That does not ever get completely eliminated. So the basic legislation that allows this to happen was in the Internal Revenue Code, Section 1400Z. That is a mechanism that allows you can take your capital gains, and as long as you put them into a qualified opportunity fund within 180 days of realizing that gain, you can get all of these capital gains tax benefits. So you have to invest into just the way the legislation is written, you have to invest in a qualified opportunity fund. You can't just invest directly in a project. That's also something that you hear a lot. People might just go buy land or buy a property. And unfortunately, I do get calls sometimes from people who say, "Oh, I just bought this, this great property in an opportunity zone," especially like in Long Beach. I don't know why that seems to be an area that happens a lot in, but they bought it themselves directly and they think they can get this capital gains tax benefits. And unfortunately, you can't. You have to have the qualified opportunity fund as that mechanism. And then the qualified opportunity fund invests in projects within opportunity zones. Then, as I mentioned, reiterating that the initial gain is deferred until 2026, and then it depends upon if you hold it for 5 years or 7 years. They either get a 10% step up in basis, or a 15% step up in basis was available up until 2020. So you might hear of that sometimes, but that was just, if you hold it for before 2026, if you've held it for 7 years, you could have gotten a 15% step up in basis. So that was available, but that is no longer available. Now it's just 10%. And then I mentioned that again, the subsequent interest that you gain is not taxed. One interesting thing that people don't talk about a lot is that there's actually no depreciation recapture in capital in the qualified opportunity fund investment. So that's also a really significant benefit. So in order to get all these tax benefits, a qualified opportunity fund has to invest in qualified opportunity zone property. So it has to have, you'll hear this 90% asset test. That means you have to have 90% of what is in the fund has to be invested in opportunity zone stock, opportunity zone partnership interests, or qualified opportunity zone business property. The vast majority of these funds are in qualified opportunity zone business property, and because they're mostly in real estate. They can invest in businesses, and that's where you'll get the stock or the partnership interests. That's a little bit more difficult and more complicated. We're seeing more of that happen as people are starting to get their heads around it, but it has its own risks when you're dealing with startups, because you have to have a substantial improvement requirement, and that's for both real estate and businesses. So that's much easier and much simpler to get with real estate. So the rules for real estate, you have to have your qualified opportunity zone business property. So it has to be used in a trade or business in a QOZ. So it has to be something that has that trade or business. That's an important bit. That's where condo sales are not really appropriate. You have to have it where it is generating some kind of income. You can't just build a single family home, is really what that's saying. And then the substantial improvement requirement, you have to substantially improve the property after 30 months of putting the qualified opportunity fund acquires that property. That's been interpreted to mean that you have to double the taxable basis of the structures on the property. And really, that means that most of these deals are going to be ground up development. And then as long as that's completed within 30 months, you meet that requirement. So the rules for businesses, which, as I said, are much less common. You have to have 50% of the gross income from an active trade or business in a QOZ. So you can conduct business outside of a QOZ as long as you meet that 50% gross income test. There's no sin businesses, so there's a long list of those. You can't have liquor stores, racetracks, that kind of thing. And then substantially all of the tangible property leased or owned is QOZ business property. So that has to meet the same tests as for the real estate investors. And then the substantial portion of intangible property is used in active conduct of a trade or business in a QOZ. So those rules for businesses they're slightly more complicated, but it's really that you'll see the vast majority of these funds are real estate funds. So I get this question a lot, why is this better or different than, from a 1031 exchange? So as I mentioned initially, capital gains from any source can be rolled over. And a 1031, as I'm sure many of you know, it can only be done for like-kind real estate. The other difference is only capital gains can be rolled over into an opportunity fund and get the tax benefits. So for example, if a property is sold for $1 million and the owners purchased it for $400,000, then that $600,000 of that can be rolled over and the owner can actually take the rest as cash. With a 1031, if you want to get the tax benefits, it's really that you can't take that cash without it being taxed. So that's a slight difference. Also, with obviously with a 1031, you can keep going with those, and there's no greater or equal value test in a qualified opportunity fund. That's just not. You can invest as much or as little as you want. Whereas with a 1031, you have to be looking for your up-leg property. The other difference, which is a slight disadvantage that I mentioned already, is that the initial gain in a qualified opportunity fund will be taxed in 2026. Whereas, with a 1031, you could, in theory, defer that indefinitely. But on exit is where you really see a huge difference, because in a 1031, when you exit, at some point, regardless if it was 5 years from now or 50, if you start this really early, you will be taxed at that point. Whereas with the qualified opportunity fund, it's that exit that's not taxed that really is a huge advantage. And then really going back to this, it is also the only mechanism available to people with capital gains from non-real estate sources. So the ideal QOZ investor, sort of the profile that this is really designed for, is obviously someone with capital gains, and they typically have to be in excess of 50,000 or 100,000. You'll see most funds will have that limit. There's no upper limit, but most funds have a minimum investment of 100,000, although you do see some that are 50,000. And then from non-real estate sources like stocks or securities, sale of a business, or if you have it from real estate sources, but you don't want to do a 1031 exchange. There can be a number of reasons why you wouldn't want to do a 1031. The most common one I hear from people is they don't like the time pressure. And so that actually, I should have talked about that in the differences. With a 1031, you have that 45-day identification period, whereas with a qualified opportunity fund, you have 180 days. So it gives you a little bit more flexibility, and that 45 days for some people, that can be very stressful. And then with the QOZ investors, you have to be willing to tie up capital for 10 years. That's just a basic mandate of this legislation. So this is just an example of if you have an investor with a capital gain from stock. Let's just say it's 100,000 in gain. I put the long-term cumulative tax rate from New York on both, so that comes out to about 33%. So if you do this with a QOZ, the taxes that you'd pay today, you'd pay in 2026 would be, 27,792. So that's with that 10% sort of discount that you get if you go through the QOZ mechanism. So without a QOZ, there's a little bit more, just about a little over 32,000. So that is a difference, but it's not a huge difference. What that does mean, though, is the cash that you have to invest today, if you do it with a QOZ, you roll over that whole 100,000. If you do it without a QOZ, you have to pay tax today, and then what you're able to then invest into a project comes out to about 67,000. Then if you take that, and I put the 135% LP return, that's actually based upon a project that we're raising money for right now. So that is a real return. When you have that 100,000 to invest, that comes out to 235,000. If you're only investing 67,000 because you've had to pay that gain today, that comes out to 158,000. So that's a really significant difference there. If you just look at that return profile, then that 10-year gain is 135,000 if you have the QOZ, and you don't have to pay any tax on that. Whereas if you have that 10-year gain, your initial investment was lower, so the gain is lower, and it comes out to about 90,000, and then you have to pay tax on that. So what you have remaining, and when I did that, I did it for the same, assuming the same long-term cumulative tax rate, and assuming you're in New York, that comes out to 61,000. So if you look at that, we're looking at over double your take-home cash if you go through the QOZ mechanism, as opposed to going to not having a QOZ and using that gain from a stock and just investing it into a non-QOZ project. So yeah, as I said, that comes out to about 73,000 difference if you go the QOZ mechanism. So there are some common misconceptions in that I hear a lot. One is less of a misconception and more just something that people don't realize is the working capital. That is a mechanism that allows people to effectively have 61 months before you have to meet the substantial improvement test. That's because once you roll over, 31 months of that you can hold as working capital within the fund. So it doesn't actually have to be deployed into the project. It just has to be from the fund to the qualified opportunity zone business. Then once it's put into the property, you have 30 months to meet the significant substantial improvement test. So that, just from a development standpoint, really takes the risk out of development delays, because you might have an issue with construction or entitlements, and having a total of 61 months really helps with that. So then the 10-year hold period, another big misconception here is that the 10-year hold period does not refer to the interest in the property. It refers to the investor's interest in the fund. So that means that the fund manager or the GP of the fund can actually authorize a sale of a property before that 10-year hold period. And then you have 10 months after that to redeploy whatever capital you have into another QOZ project. That's not something we expect to see a lot of because it's less certain, it's a little bit more risky. You want to have a project that is anticipated to be held for 10 years. But if you're looking at a fund that has multiple assets, that might be something that they'll do and buy and sell within, maybe within 5 years. And that really could end up maximizing results. And the benefit of that is, if a certain area is just exploding in terms of property prices, you could take advantage of that and then get that increase and then sell that asset and then redeploy it into a new QOZ project. Another thing that people wonder about a lot, especially with multifamily, is affordable housing in QOZs. So it definitely can be affordable housing, and we'll see a lot of that because it's appropriate for the types of areas that these are being built in. But it doesn't have to be. And most of these projects are not affordable housing. They might be workforce housing, but there's no requirement to have that, rent subsidy or, to have actual affordable housing. So the long-term benefits of investing in a qualified opportunity fund are obviously the tax benefits and that capital gains exclusion after 10 years. But then also, because this is a really targeted improvement to these areas, we're going to see a lot of concentrating of investment into these designated zones. And that means that these areas are likely to increase their sales prices disproportionately to other areas. So I have a map of qualified opportunity zones in the greater Los Angeles area. And what you can see is that there's not a lot of them. They are designated census tracts. And just looking at it, you can see that they're really targeting certain areas, and we're going to see a lot of investment into those areas, and we expect to see them disproportionately increase in prices over the 10-year hold period. And so that just maximizes your untaxed gain after 10 years. So there's risks to any investment. The big one in the QOZ space is that most of this is going to be ground up development. And that's because of the significant improvement test, which I mentioned, and that really means that you're going to see a lot of ground up development. Especially in the Los Angeles area, there's not going to be a lot of properties that are so run down that you're going to be able to double the taxable basis of that structure within 30 months. So there's a lot of risks to ground up development, and that is obviously something that's needs to be addressed when you're looking at different funds. And then it's a non-liquid investment. You have that 10-year commitment. An investor could sell their share in the fund, but the buyer of that interest wouldn't get the tax benefits. So you're not really going to see a lot of selling of interests, and that is just a disadvantage of this program. And then you're going to have a lot of unproven funds. As I mentioned, the final IRS regulations only came out in early 2020. So most of these funds don't have any kind of track record specific to qualified opportunity funds that they can show investors. you'll have a lot of people, you have to look at the developer themselves and the fund managers themselves and see what kind of history they have. Other projects that are not in qualified opportunity zones that they've worked on is really important when you're selecting a fund. So, this is sort of a very topical thing at the moment with political and legislative changes. What is great about opportunity zones is that it was actually passed with overwhelming bipartisan support. And that is because it is a tax break that is taking money into underserved communities. So we really do not expect to see any changes to opportunity zone legislation. It was a very bipartisan piece of legislation that passed. And then the other side to that, where we do expect to possibly see some legislative changes, is in 1031 exchanges. There's Biden himself has proposed eliminating 1031 exchanges for those with annual income greater than 400,000. So that would leave the qualified opportunity funds and QOZ legislation as the only option available to many investors gains. Then there's also the 2020 census. So that might shift the census tracts. The Treasury has clarified that the qualified opportunity zone designations are on the boundaries of the tract at the designation in 2018. So they've clarified that a project will not sort of be moved out of an opportunity zone. They're always looking at how the census tracts were in 2018. So, projects will not lose their QOZ designation if those census tracts shift. So I've talked about this a little bit. It's really important to look at certain things when you're choosing a qualified opportunity fund. So most of these will be single asset. You do get some multi-asset funds. And that's a very popular mechanism for real estate anyway, the multi-asset fund. But the vast majority of the opportunity funds that I've seen are single asset. And that's really where you're going to get more security because you're able to look at a particular project. Multi-asset funds, you're giving a lot more discretion to the fund manager. And so there's just, that's just something to consider. If you're comfortable with that, if you know the fund manager very well and they have a track record in other real estate funds they can show, then that's fine. But the vast majority of these you're going to see are single asset. Then you have to look at the track record of developers because you're not going to have any kind of track record for the GP of the fund because, as I said, these are qualified opportunity funds are all very new. So you really look at the track record of the developers. Where I look for it just in due diligence, and this is whether it's an opportunity fund or whether it's you really have to look at how conservative the numbers are that developers put forward and the size of the reserve for both the fund and the project. We've put into most of our funds, we have like a 5% reserve at the fund level and then a 10% reserve at the project level. And especially when we're looking at a 10-year hold period, you really want to make sure that there's enough of a reserve to cover anything unexpected over that 10-year period. So the typical returns that we're seeing, what we always look at is not just the 10-year IRR, but also the 3-year untrended IRR. And that's just to compare it to other real estate investments so that you're actually looking at apples to apples. So in major cities, the 3-year we're seeing 9 to 13%, and that makes the 10-year 7 to 9%. And then secondary or tertiary markets, you have the 3-year more 14 to 19%, and then the 10 years 10 to 13%. One thing that we always put into our funds when we structure them is a refinancing event to pay the 2026 tax. Not all funds do this, but if I were rolling over gains into a fund, this is something I would really want to see. That way you're not paying that 2026 tax out of pocket. So how the pandemic is shaping real estate investment is also something I get asked a lot. We're seeing a real shift in the asset classes that people are investing in. Multifamily is really dominating the real estate space right now. And that's because office and retail, there's a lot less certainty in their futures. There's a lot less demand for office space and retail space right now. So, and especially when you're doing ground up construction, really everyone's looking at multifamily. We're seeing a really interesting shift from major cities to nearby smaller cities and suburbs. Rents are decreasing in major cities. In San Francisco, they're down 31% over last year. And in New York, they're down 15%. I mean, in San Francisco has never seen a decrease in rent, or I'm sure it has decades and decades ago, but there's been a steady increase in rents in San Francisco going back decades. So the fact that it's down 31% is showing a really significant change. And then, interestingly, rents in secondary and tertiary cities such as Fresno and Tulsa are up 15% and 36% respectively. We're also seeing the sales prices in these smaller cities and the days on market really are reflecting a demand for single-family homes outside of major cities, because you're having the sales prices are increasing and the days on market are decreasing. And we're really expecting to see changes in commuting. More people are working. Obviously, we're all working from home now, and we're getting people who won't be wanting to commute, and we're going to have a lot of these companies are not going to want to pay for prime office space in major cities, or maybe not as much of it. Instead of renting 20,000 square feet of office space, some of these big companies will rent 2,000 and then have satellite offices in smaller cities. So I would expect to see more investment into smaller cities and more projects that are within commuting distance of big cities, but have satellite offices outside of major cities. So this is a little bit about a fund that I'm currently raising money for. It is a $12 million offering. Minimum investment is $100,000. And we're looking at a targeted annualized IRR of the 3-year, just for comparative purposes, at 18%, and the 10-year at 10 to 12%. That fund is for a project called the Peach Apartments in Fresno. It's new construction, as many of these funds will be. It's fully entitled on a little over 4 acres. It's going to be 5 3-story buildings with 129 apartment units. The total project cost is $20 million, which is why we're looking at a $12 million equity raise. And that's expected to be completed in June of 2022. This is workforce housing, not affordable housing, but that's really an asset class that we're expecting to be very strong over the next 10 years. And why I really like Fresno is it's the 5th largest city in California, and the average rents have increased by 15% in 2020. And I'm expected to continue to see that kind of trend. The California high-speed rail is currently under construction and runs through Fresno. They did the groundbreaking for that in Fresno. And Fresno is in between San Francisco and Los Angeles on that rail line. There's going to be the total travel time from San Francisco to Los Angeles is predicted to be at a little under 3 hours. So that means that from Fresno, you'd be able to get to either Los Angeles or San Francisco in under 2 hours. So I'm really thinking we're going to see a lot more people that are going to want to live on that rail line and be able to get into the office, maybe once a week instead of every day, as we see the shift to people being able to work remotely or in satellite offices. And then it's also, there are interesting things about it. There's the California State University, Fresno, and it has a minor league baseball team. And so those all show that there's a thriving neighborhood there, and a lot of attractions that make this I believe, a very strong project to be involved in. This is just a picture of the facade of this project. And then I would like to open this up to any questions that people have had. So Jason, are you there?
Yes, can you hear me?
Yes, I can hear you.
Okay, there we go. Thank you so much for sharing that. Really interesting, and especially, I don't know if you had talked about it, but with some of the potential changes when it comes up to if there is some changes in the Biden tax plan, I'd like to talk to you a little bit about what the potential advantages of doing something like this would be, especially. I guess the way I think about it is if someone's relocating out of San Francisco and they're going to go to Fresno, they might have a lot more equity, than they need, for example, right, in their home. And for those that don't know, if you are single, you can exclude up to $250,000 from capital gains, and for married, filing jointly, it's $500,000. But if you're in San Francisco and you are a high-paid tech professional and you're making over the $400,000 with income limit of what's apparently being set as where are those exclusions might go away. Maybe you could talk about that a little bit and how this might be a good fit for somebody, either in that case or maybe some other cases you can think of.
Yeah. So what will be interesting to see is how the capital gains rate will change, because as that cumulative tax rate increases, that will be make the ultimate exclusion that you get more significant. Because if obviously then you're getting more of a benefit than you would have. And it's almost more important to have these kind of mechanisms because if the capital gains tax rate is higher, it's all the more important to try to exclude that. Where you're going to see, really that, excuse me, having that 1031 exchange potentially not be available for those with $400,000 or more in annual income, that would mean that this would be the only mechanism available. And that has been floated. I don't know how far along they would be on that. So that remains to be seen. And obviously, even if it is proposed, it doesn't necessarily mean it's going to pass. But we don't expect to see any legislative changes to the qualified opportunity zone rules. The only thing that would maybe happen is that those rules would be expanded to allow for more investors as 1031s maybe go away. And that's something that's been flipped, but 1031s have been attacked numerous times for a while. People don't understand the benefits of a 1031 to communities. I mean, buyers spend money on their properties, and people who've owned a property for a long time typically don't put new resources into those. So the 1031 is a great mechanism for continuing to have vitality in real estate. But a lot of people don't understand that. But at least with the opportunity zones, people really understand the benefit to these communities. That's been, really championed very well. And, because it's designated for these underserved communities, that's really, at least politically, people understand that a lot better than they understand 1031s. So I would expect to see definitely no decrease in any of the QOZ legislation, but possibly seeing an increase and an expansion. Maybe that 2026 deadline will get pushed back. That would be the ideal. Some people are talking about that as a possibility, and if that happens, that would be really fantastic.
Excellent. So I guess my interpretation, just being somebody who does management of mutual funds, ETF stocks, things like that, it seems like if you are in a place where you might be wanting to sell some stock, wanting to diversify your portfolio, and you have some single stocks that you might have gotten inherited or you might have had for 20 or 30, 40 years that have a lot of gain in them, this is a great way to possibly either reduce or even eliminate a big chunk of those taxes and make a return additionally as well as your money is sitting there. Do you think that's a good client for an opportunity zone, or are there some other particular type of clients that you think might be a good fit for what you're talking about here?
No, certainly the ideal client really is someone who has significant capital gains from something like stocks or anything that's not real estate. And that's really because the 1031 exchange is a fabulous tool if you're in real estate and want to stay in real estate. And opportunity zones are great as well if you have gains from real estate, but they don't offer the same advantages that a 1031 does. So definitely people who have gains from stocks or bonds are a great client for an opportunity fund.
Okay, great. And I saw the returns are generally somewhere between 9 to 13%, depending on the quality of the project and things are where it's located. If someone wanted to invest in let's say a fund like yours, what are the fees to the investor, and are those returns net of fees generally, or is that prior to fees? For someone who manages a fund.
So at least with our projects, those returns are net of fees. So we include, I mean, it's pretty typical. It's pretty much the same if whether you're in an opportunity fund or a non-OZ real estate fund. You're looking at a 2% management fee annually, and 20% as a promote on the back end is really typical, and that's really whether it's an OZ deal or a non-OZ deal. There shouldn't be any special fees put in just because it's an OZ deal. If you see someone doing that, I would ask why. What are they doing those fees for? And maybe they have a reason. Maybe they are going to be paying attorneys or something. But you should really be looking at a similar standard 2 and 20 that you would see in any real estate fund.
Okay, great. And then I know you pulled up a map of California, but my understanding is California has some of the lowest amount of opportunity zones compared to things like if you go to other southern states and other areas that just haven't had a lot of investment for decades. There's probably a lot of folks that are going to watch this from around the country. One, if they're not in California, can they still invest in a fund in California like you're running? And then also, if they're looking at other areas, what are some other popular areas for opportunity zones in the US?
Great. Yeah. So I'm actually also working on a project in Texas. Another that is a really hot area for opportunity zones. There's a lot in Florida where you're seeing like less is sort of the more rural areas. And then that's just because of real estate. People typically want to invest in real estate in or around cities. But what is interesting, just if you are an investor, you don't have to stay within your state. You can invest in any project across the country. What is very significant in that is, so for instance, California, our state doesn't, the state tax doesn't follow the national rules, the federal rules. And that doesn't mean if you are an investor in Texas, you can invest in a California-based qualified opportunity fund, and the state tax rules are based upon where the investor is, not where the project is. It really, that's where it's a fund. Your personal taxes are based upon you and where you are, not where the fund is investing in. So that is really significant. Especially if you're in Texas, looking at other states, that's a really significant thing to note.
Absolutely. California, there's quite a few things that hurt me that they don't follow along. Simple things like your health savings accounts. It's just they got to squeeze everything they can out of us here. So, just what it is. We have a question from someone that's watching. So Tamara asks, how would you quantify risk as compared to other investments the average Joe might be more familiar with? So I'm assuming she's just thinking about just normal mutual fund or, something like that.
So I would say it really depends upon the project, because this is essentially a real estate deal. All of these funds are, except for the few that will be doing businesses, you really have to look at the risk of the project, the underlying project. So for some, for instance, the Fresno project that we're raising equity for, that is relatively low risk because it's a multifamily project in a city. It's very plain, simple. There's nothing particularly out there about it. Whereas I did actually, we had a project that someone was asking us to get involved with that we decided not to get involved with because it was to raise money for a stadium. And that's a really high risk project. And so you want to see things that are not really out there in terms of the projects. That's where you have that risk. So it could be very similar to a mutual fund if it has a simple outlined a project that is kind of normal. Then we're not seeing really anything out there. Multifamily in particular, you can look at a ton of multifamily projects. It's a relatively stable asset class because everybody needs a place to live. So those are where you're seeing the lower risk, and the higher risk are really unique projects that they might be exciting, but there's a lot more risk involved in those.
Yeah, you mentioned the stadiums. That's something, who knows when those are going to be open back up, right?
Right.
So I'm with you. I'm definitely with you on that. So before we wrap up, are there any, tips, resources, really, if somebody knows that they have this, some sort of capital gain they're sitting on from somewhere, uh, that they want to possibly do something different to eliminate some of the taxes, take advantage of what you mentioned today, and keep more of their return? What would you recommend for people as far as, either somewhere to go or, possibly even contacting you?
Yeah, well, you can obviously, if anyone is interested in learning more about our fund or just opportunity zones in general, you very much feel free to look at our website and see some of the projects we have on there, and some more resources on opportunity zones. There are a number of websites that have more information and a lot of more Q&A sort of style. The one is the OZ Expo website is a really good resource, and there's also Opportunity Database, Opportunity DB, I think is the website itself. So that really look at a lot of funds. If you are looking to roll over, the legislation is obviously the same no matter where you are in the country, but look at a lot of funds and really look at the developer's track record. Yeah, I would say that that's really the most important thing when you're choosing an opportunity fund. I personally would be wary of funds that are investing in businesses if they don't also have a very strong real estate element to them, just because their startups are really what these businesses are going to be, because they have to be new. That's part of the legislation. So I would be wary of anything that has a really strong or is really heavily involved in businesses as opposed to real estate.
Yeah, excellent. Yeah, because if it's a brand new business and where they say 80% fail within 5 years or something like that,
Right.
that's not a great. But the apartments, I think, especially with what we probably have coming in real estate after all these forbearances and extensions
Mhm.
dry up, I think apartments are probably going to be a solid place for quite a while here with all that. So great. Anything else at all but that you want to share before we wrap up for today? This was excellent. I learned a ton, and I probably need to go back and watch it again because there's just so much good information. But it will be here on our page for everybody to watch who would like to watch it later. But anything else you would like to mention before we wrap up for today?
No, I think I've really covered, a lot of what we wanted to talk about today. But I mean, really, anyone can feel free to reach out to me with any questions or anything that maybe they come up with later. I am available just to do an initial consult if you have anything. So I'd just say, absolutely, people feel free to reach out, and I'm available to answer any of your questions.
Excellent. And I'll put your contact information in the comments here so people can reach out to you there if that's all right. And other than that, I want to thank you so much. It was really great spending time with you today and learning about this. And if anybody really enjoyed this, please let us know in the comments. We'd love to hear from you. And if you have questions later, I'll probably add Elizabeth to the page or group so she can, if there's any questions there, she can follow up with those later. But thank you so much. And we'll wish everybody a wonderful weekend, and we'll see you next time.
Great, thank you.